Hey everybody, Signet here from the Bullish Bears. I want to welcome you to video 5 of building a trade plan. In this video we're going to talk about the amount of time that you're looking to be in a trade. Now that might seem kind of arbitrary, right? Typically you get in and you need price to get to a certain point and then you're going to get out, so how are you supposed to know how long you're going to be in the trade? But that's not exactly true, especially when you're trading options. This doesn't necessarily have to be options specific. When I trade futures, it's an intraday trade and I'm out of the trade by the end of the day. I have to so I can settle with the market makers. But time in the trade, when it comes to evaluating your trade strategy and you're getting ready to pull the trigger, you need a good, strong understanding of how long you anticipate being in the trade, and you can actually develop your trade strategy on those type of time frames. For an example, we do a lot of intra-week trading, and we know that we're using Friday options. Even if it's Thursday, we're still going to look to use Friday's options, right? That's the trade as it's developed. So time in a trade is a key part of building a trading plan. There's nothing wrong with multiple time frames, right? You can do a debit spread on a week using Friday's options. You could do it on a Wednesday if you're trading SPY, or a Monday. It it doesn't have to be one specific thing, but the idea is that you want to develop in your trading plan what that time frame is going to be, and really um, break out in the plan why you're using that time frame. For an example, the weekly options that I was just talking about. Weekly options, if you use Friday expiration options, those are very, very sensitive, volatile options. They will gain or lose value very quickly. You do not need a very large move in the underlying market to hit your target profit goals. And so they're a very nice trade to take, but it's a lot harder to trade an intra-week strategy than it is to trade, a swing trade with 6 weeks or 2 months in your trade plan. Master level options trading is on the intra-week. It is it is almost running on a gut instinct, and we really want to avoid trading with our gut. We want to trade with a plan, but there are so many small nuances that go into an intra-week trade that you really can't flesh them all out on paper, right? You'd end up having to write a book. And so a lot of the times, when it comes down to pulling the trigger, you can you can have everything on your checklist done, and when it comes to pulling the trigger, you just might have that feeling, like I'm just I'm just not going to take this. Something ain't right, and I'm going to pass. And your instincts would be right. So it it does need to be defined. When you're building your trading plan, you need to understand what time frame is appropriate for your goals, for your targets, for the trade that you're taking, and then build that into your plan and have it in stone, have it in cement. This is a weekly plan. I'm expecting to be using Friday expirations only. And if you run across a situation where Friday's expiration isn't going to work for you, you have to stop right there. You have to stop and either pull out a different plan or create some new rules that would use some other time frame instead of the Friday that you're supposed to use. If you've been listening to this video series, you might be thinking by now that I'm naming off some things that just don't seem like things you have to write down, right? You might think, oh, this is common sense. Why do I need to pay attention to the time frames? It really is critical when you're developing your trades that you understand exactly what the time frame is. There are a lot of strategies when it comes to butterflies, iron condors, call diagonals that use an intra-week trading strategy, and they are amazing, but they're a low probability trade. That ought to be a big warning flag when you hear low probability, right? That means you're going to lose a lot. Now, typically, when we're looking at a trade where you lose a lot, then we're talking about losing a number of occurrences, not losing a lot of money, right? We don't want to put a lot of risk into those trades that are a low probability trade. But it does matter. It matters a lot when you go. If you've watched any of my videos on the debit spread or the credit spread, the risk twist spread, all of those in the video, I specify very clearly what time frame we're trading in. I talk about not getting too close to expiration, and so a lot of the times I'll have a window there saying we need to find options between 30 days and 90 days, right? And we need to be completely out of the trade no more than 24 days from expiration. There's a defined time frame. I didn't throw those in there for fun. They are a specific part of the plan. Your options, the Greeks in them change a lot once you drop below that 28-day time period. So if you get into a trade in the 80 or 90-day range, once you drop below that 28 days, your options have completely changed from what you entered into the market with. It's not the same trade anymore at that point. It will react differently. The definitions of the trade will be completely different at that point. So you have to build time in your trade. How long are you going to be there? What are the rules? And you have to follow those rules. They're critically important to the success of your trading. If your strategy says to get out with less than 5 days to expiration, you can't hold that thing up to 1 day. You're breaking the rules. There's a very big reason why that time frame was in there, and you're increasing your risk exponentially. And I mean that 100%. If you're in a trade that is a 60-40 and you've got a 60% chance of winning, you hold that trade into the last week, and it's not even close to being a 60-40 anymore. You have given away all your edge, and you are stepping into a whole new risk zone. Whatever your trade logic is when it comes to time, you need to stick to it. Now, in this video, I'm not going to go through all the different time frames for all the different trades, because that would be like a 5-part series. We'd have to just do multiple videos just on that. Instead, what I wanted to do in this video is really get your mind on the idea that you need a time frame if you're trading options. How far out are you going to go to get in? How far are you going to stay in the trade before you get out? And that rolls back into the time frame that you're trading, and that rolls back into the type of strategy. All of this comes together. The pieces start building the picture. So, time in a trade. How long are you going to be in the trade? And from that, it really helps with your analysis, right? Because if you know you're doing an intra-week trading strategy, you could use expected move indicators, implied volatility. You could use moving averages, support and resistance lines. You can anticipate social events, binary events, FOMC meetings. All of these things can be used as a part of your trading strategy on an intra-week basis. All right. Even earnings or a lack of earnings can be a part of your intra-week trading strategy. But the the whole defining piece is how long are you looking to be in the trade? And I know I keep using the examples of the midweek or the Friday expiration trades, but that really is only one small piece. There are trade strategies out there where we look for, a year, 6 months. I'm not one who likes to go out a year in time. I think going longer than 110 days is getting you into leaps, and at that point, you're just dealing with a mess. You want to avoid leaps. But there are some really good markets right now where I've got projections all the way up into the end of next year. That's a 6-month projection, and I'm trading it with that projection. Now, I don't look to be in one single trade that long, but when I'm performing my analysis, I've already analyzed and projected price in the future 6 months. And I trade each week with that goal in mind, and it hasn't changed. The projections are still solid. There are a lot of ways that we can trade time, But one of the key things when it comes to time is the expected move. Now you can see here EA Sports has a $9 expected move in the next 30 days. That might seem like a lot to you. It might seem very small to you. When we go to Amazon, in the same 30 days, we're looking at a $128 expected move in Amazon in the next 31 days. All right, so when depending on the market that you're trading and the time frame that you're trading in, you can get some really big distance out of the marketplace. But another thing that matters when you're looking at time is looking at expected move from the other point of view. And what I mean by that is if you're looking at something and you need it to go $5, if you're going to trade it for a week and the expected move is $1.50, you're not going to hit your target. Now, not ever, never. We all know that there are extremes in the marketplace, and there could be a massive move and you could hit your target, but that'd be an occurrence, right? That would be a rare market event. You can't put a rare market event as a part of your trading strategy. It's just, you might as well go buy lottery tickets if that is how you want to trade. Looking at something like this, we've had these waves, and even though the wave went higher this time, the time frame still fit, right? And that's the kind of thing that we want to look at. We want to measure and project our movement in price and then ask, does it fit into our time frame and does it work for what we're about to trade? Is it appropriate? And then when we analyze that, we go into the options, and then we got to start connecting the pieces for the size of our account, how wide the strikes are going to be. Can we fade in? Can we fade out? Volatility, credit spreads, those don't just use price, those use time. So time in the trade absolutely has a lot to do with your trading plan. It needs to be written down. It needs to be a part of the structure so that you know it, you see it, you recognize it, you acknowledge that it's there, and this way you can be held accountable. If you lose a trade and it was because it was outside of your time range, you don't have anybody to look at. You have no fingers to point except at yourself. Right? And that's one of the key pieces about having a trading plan is that you can be held accountable for what you do. You can take responsibility and say, you know what, I broke my plan and I failed in this trade and it's my fault. I didn't follow my rules. Setting that aside, when you lose a trade and you're analyzing it and comparing it to your trade strategy, if you follow the rules and you did everything right, and you go back and analyze the charts and find something new that you didn't even recognize, you didn't acknowledge it in your plan because it never wasn't something you ever thought of. Now you can add that into your plan so it won't happen next time. So building a plan has to have these pieces in it. It has to be defined. You can't rely on your memory. You can't just write it down in a document and then never look at it again. You have to know it, study it, make it a part of what it is that you do. So time in the plan is a critical piece of all of this. And I don't really have much more to say on that. It has to be fleshed out. Now, in the videos that I've made for the credit spreads, the debit spreads, iron condors, I defined those time frames already. Even though I was pointing at a very specific strategy, those strategies had a time frame. If you're building a trade strategy and you don't know what time frame would be the most appropriate, you can come to the chat room and find me, give me a holler, send me an email. My email's in the room drive. You can research it. It gives you something to hunt for to find that answer, to get those definitions. We are a trading community, but we're a learning community. So we're to help you, and if you can't find the answers, we're here to help you find those answers. So I want to thank you for watching this video. I appreciate your time. I look forward to seeing you at the next one.